In the autumn of 2001, the seventh largest company in America was worth tens of billions of dollars. Within weeks, it was worth almost nothing. Thousands lost their jobs, their savings, and their faith in the numbers. This is the story of Enron, a company so celebrated that Fortune named it America's most innovative business 6 years in a row. But behind the awards was an accounting illusion. This is how it was built and how it fell. Enron was born in 1985 from the merger of two pipeline companies, Houston Natural Gas and Internorth. At first, it was exactly what it looked like, a sprawling, unglamorous business that moved natural gas through thousands of miles of steel pipe. At the helm stood the company's founder, a soft-spoken economist with a doctorate and big ambitions. He believed energy didn't have to be a boring utility. It could be reinvented as a fast-moving financial market. That vision would make him a legend and then a defendant. To turn pipelines into profits, he recruited a brilliant, intensely competitive consultant who became the company's strategic engine. His idea was radical. Enron wouldn't just sell gas. It would trade it like stocks, becoming a Wall Street firm dressed as an energy company. Skilling created a gas bank where Enron sat between buyers and sellers, guaranteeing supply and price. It was genuinely clever, and for a while, genuinely successful. The trouble began not with the idea, but with the accounting Enron used to report it. Here's the first red flag. Skilling won approval to use mark-to-market accounting. That meant when Enron signed a long-term deal, it could book the entire estimated future profit immediately, even though the cash might take 10 or 20 years to actually arrive. Think about what that does. Profit becomes a guess, written by the people who are paid to hit their targets. If real earnings ever dipped, Enron only needed more deals, with more optimistic projections to keep the numbers climbing. It was a treadmill that could never stop. Wall Street loved the story. The stock soared, analysts cheered, and Enron expanded far beyond gas, into electricity, water, broadband, even trading the weather. The company seemed to be everywhere and untouchable. Inside, the culture turned ruthless. Skilling installed a brutal ranking system where the lowest scoring employees were fired every year. It rewarded swagger and deal-making over caution, and it taught everyone that bad news was career suicide. But the treadmill had a problem. All those aggressive deals created enormous debt and shaky assets that would look terrible on Enron's balance sheet. If investors saw the real risk, the magical stock price could collapse. Enron needed somewhere to hide it. Enter the man who would build the hiding places, a young, financially gifted chief financial officer. Court records show he engineered a web of secret partnerships designed to make Enron's numbers look exactly as good as the company needed them to look. These were called special purpose entities, companies with strange names like LJM, Chuco, and the Raptors. On paper, they were independent. In reality, prosecutors said they existed to absorb Enron's debt and buy its failing assets, keeping the losses out of sight. Here's why this matters. A legitimate special purpose entity must be truly independent, with real outside investors taking real risk. Enron's were funded with its own stock and run, in part, by its own CFO. The independence was an illusion, and that illusion was the fraud. The conflict of interest was staggering. The SEC later alleged the CFO secretly profited from the very partnerships that were doing deals with the company he was supposed to protect. He was sitting on both sides of the table, negotiating against his own shareholders. None of this could have worked alone. Enron's outside auditor, the prestigious firm Arthur Andersen, signed off on the books year after year. Andersen also earned millions from Enron in consulting fees. A cozy relationship that blurred the line between watchdog and business partner. Here's the structural lesson. When the people checking the numbers are paid by the people making the numbers, the check becomes a courtesy. Enron's gatekeepers, auditors, bankers, analysts, all had reasons to keep the party going, and almost none had a reason to stop it. For years, the machine hummed. Enron reported smooth rising earnings while quietly stuffing billions in debt into its hidden partnerships. The founder and his executives were celebrated as visionaries, and the stock kept climbing toward $90 a share. Enron built a gleaming new headquarters in Houston and a famously volatile trading floor, where deals worth millions were made in seconds. The company projected total confidence. To question it, inside or out, was to look like you simply didn't understand the future. But a few skeptics noticed something odd. Enron made huge profits, yet generated surprisingly little actual cash. Its financial statements were dense and nearly impossible to decode. When real money and reported profit drift apart, that gap is one of the loudest warning signs in finance. In early 2001, a journalist published a now famous article asking a simple question: how exactly Does Enron make its money? It was titled, Is Enron Overpriced? The company couldn't give a clear answer. And that silence was the first hairline crack. On a now infamous conference call, an analyst pressed Skilling for a basic balance sheet. According to widely reported accounts, Skilling lost his composure and insulted him on the line. For a company built on confidence, losing your cool over a fair question was its own kind of confession. Then, in August 2001, came a shock. After only 6 months as chief executive, Skilling abruptly resigned, citing personal reasons. The man who built the engine was walking away just as it was starting to smoke. Many on Wall Street felt a chill they couldn't yet explain. The founder stepped back in as chief executive and reassured everyone the company had never been stronger. Behind closed doors, though, a senior accounting executive had just sent him a stark warning, fearing Enron would implode in a wave of accounting scandals. That executive, Sharon Watkins, became the scandal's most famous whistleblower. Her memo laid out the danger in plain language. It's a reminder that in nearly every great fraud, someone on the inside saw the truth early. The question is always whether anyone with power chooses to listen. In October 2001, the dam broke. Enron announced a shocking $600 million quarterly loss and slashed over $1 billion in shareholder equity, tied to those secret partnerships. For the first time, the public got a glimpse of the machinery hidden under the floorboards. The SEC opened a formal investigation. As outsiders finally dug into the partnerships, the carefully maintained illusion began to come apart thread by thread. Each disclosure forced another, and each one was worse than the last. Then came the most damaging admission of all. In November, Enron restated its earnings going back 4 years, erasing roughly $600 million in profits it had never really made. Years of celebrated success were quietly confessed to be fiction. Confidence is the currency of finance, and Enron had just spent its last. Credit rating agencies began downgrading the company. Trading partners stopped doing business with it. The financial market Enron had built now turned on Enron itself, draining its cash at terrifying speed. A smaller rival, Dinergy, offered a lifeline, a rescue buyout. For a moment, it looked like Enron might survive in some shrunken form. But once Dinergy's accountants saw the true depth of the hidden debts, they walked away, and the last hope vanished. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history, with more than $60 billion in assets. The company that had reinvented energy was now a symbol of collapse. The human cost was immediate and brutal. Roughly 20,000 employees lost their jobs. Many had their retirement savings locked in Enron stock that was now worthless. Life savings vaporized, while some executives had cashed out millions months earlier. Here is the cruelest detail. Employees had been encouraged to fill their 401k plans with company stock and were blocked from selling during the critical days of the collapse. The people with the least information and the least power bore the heaviest losses. As investigators closed in, attention turned to the auditor. At Arthur Andersen, employees shredded tons of Enron-related documents and deleted emails. Whatever the intent, destroying records as a federal probe loomed turned a client scandal into the auditor's own crime. Arthur Andersen was convicted of obstruction of justice in 2002. The firm surrendered its licenses and effectively ceased to exist, taking 85,000 jobs worldwide with it. One of the world's 5 great accounting firms was gone, destroyed by a single client. There is a striking legal twist here. In 2005, the US Supreme Court unanimously overturned Andersen's conviction, ruling the jury instructions were flawed. But the reversal came far too late. The firm was already dead. Reputation, once destroyed, cannot be appealed. A special Department of Justice task force pursued the executives. The former CFO, Andrew Fastow, pleaded guilty to conspiracy in 2004 and agreed to cooperate, surrendering tens of millions of dollars. He became the government's key witness against the men who had led the company. In 2006, the 2 men at the top finally faced trial. Prosecutors argued they had knowingly misled investors for years. Both insisted they were innocent, that they had trusted their accountants and were betrayed by subordinate schemes. The jury didn't buy it. In May 2006, both Kenneth Lay and Jeffrey Skilling were convicted on multiple counts of fraud and conspiracy. The leaders of America's most admired company were now convicted felons, facing decades behind bars. Then, a strange final chapter. Just weeks after his conviction, before he could be sentenced, the founder Kenneth Lay died suddenly of a heart attack while on vacation. Because he died with his appeal pending, a court vacated his conviction entirely. Skilling received the harshest sentence, originally 24 years in prison. He maintained his innocence throughout. After a later appeal reduced his term and a deal with prosecutors, he was eventually released in 2019, having served about 12 years. The shockwaves reshaped American business. In 2002, Congress passed the Sarbanes-Oxley Act, forcing chief executives to personally certify their financial statements and tightening rules on auditors. The era of trusting numbers on faith was over, but laws only treat the symptoms. The deeper cause of Enron was a culture that confused complexity with intelligence. When financial statements become too complicated for outsiders to understand, that opacity isn't sophistication. It's often a place to hide. There's a second lesson about incentives. When executives are paid in stock and rewarded only for the price going up, some will be tempted to manage the price instead of the business. Enron didn't just have bad apples, it had a barrel designed to grow them. And consider the gatekeepers once more. Auditors, banks, ratings agencies, and analysts were all supposed to protect the public. But each was paid, directly or indirectly, by Enron. A watchdog that depends on the wolf for dinner rarely barks. Enron also showed how charisma can silence doubt. For years, anyone who questioned the company was dismissed as too slow to grasp the future. Confidence is not evidence, and the more a company punishes hard questions, the more those questions deserve to be asked. Investors recovered only pennies on the dollar through years of lawsuits. Banks that had helped structure the deals paid billions in settlements. But no settlement could return the retirements that vanished or the trust that was broken. Today, Enron is taught in every business school as the textbook case of accounting fraud and corporate hubris. Its gleaming Houston tower was sold off. Its name became shorthand for deception. A once-admired empire reduced to a cautionary tale. The most haunting truth is how ordinary the path was. There was no single dramatic theft, just thousands of small decisions to round up, to hide a little, to believe the optimistic number. Big frauds rarely begin as crimes. They begin as conveniences. Enron's collapse remains a warning that profit on paper is not the same as money in the bank. And that admiration is no substitute for accountability. If a company's success can't be explained simply, perhaps it can't be trusted at all. Subscribe for more financial crime documentaries that reveal how the biggest frauds in history really worked.